Hello everyone and welcome back to my channel. In today's video, we're going to talk about one of the most bizarre or intriguing EV companies that has been trading on the Nasdaq, Canoo Inc., trading under the ticker symbol GOEV or GOEV. It has been one of the most, talked about or rising stars back in the 2020 era when every single EV stock seemed to be the next Tesla, and everything seems to be on the up and up forever and the eternity to come. Obviously, this is not how things eventually played out, and today people are left wondering whether there is any possibility for Canoo to recover to its former glories. In this video, we're going to talk about Canoo, its recent price actions, the technicals, and what is the best trading approach given the circumstances. Before the video begins, if you would like to see more stock analysis videos like this one, please remember to like, comment, and subscribe to my channel. Over the past few months, we have seen Canoo going down by more than 60% of its stock value in the market, currently sitting at around 25 cents, down from a peak of 60 cents. Although the current support level seems to be a floor as it has been tested once in November, the current market dynamics are far from reassuring. There's no indication as to when the market will allow Canoo to come back up, and the fundamentals are not showing anything that is actually encouraging for the investors. And the sector is now showing that the interest for EV is waning amongst the auto buyers. We previously mentioned that there may be a problem with the market cap valuation formula for the EV manufacturers, as they're often considered to be tech companies instead of manufacturers. I believe that in the upcoming years, we may see a shift in the market to align them more on the traditional auto manufacturers, resulting in additional tumbling in the sector. What gives Canoo somewhat of a respite is that it does have a significant order backlog of companies that are interested in buying its vehicles. But in order to even make those cars, the company would need to raise additional capital to fulfill the existing demand. And what this means is that there will be some hope for the company in the future, but in order to reach it, it may have to go through some very painful adjustments for its existing shareholders. For now, I think that Canoo has reached a short-term bottom and will be testing it in the upcoming weeks, but it is by no means a guarantee that things will only improve from here onward. With that being said, here's what the technicals are telling us. The trading volume of Canoo has recently been around 50 million shares compared to an average volume of 31 million shares. Over the previous 52 weeks period, the price fluctuated between 22 cents and $1.50. The volume of shares traded tells us how many shares have been bought and sold at any given time in the market, and if there is enough liquidity to support a trading strategy. If the float remains thin, it would be very easy to influence the stock price, but low liquidity could mean that the demand is limited as well. When we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is very large. For example, if the stock were to break through, the current volume would be significantly higher than the average volume. The market cap of Canoo is currently around $190 million. Now, as we compare the current price to the historical price fluctuations, the stock is about 12% higher than the 1-month low, 16% higher than the 3-month low, and 16% higher than the 52 weeks low. On the options market, which often gives a hint on the market sentiment about where the stock price will head next, the implied volatility is 230% compared to a historical volatility of 103%. The put-call volume ratio is currently around 5%. It is normal for most stocks to also have a higher put option volume than what they deserve, because many institutional investors hedge their long positions by buying put options. The most recent volume of options traded is 2.5 thousand contracts a day versus the 30-day average volume of 5.3 thousands. Regarding the open interest, the most recent volume of open interest is about 439,000 contracts versus the 30-day average of 424,000 contracts. In terms of shareholder structure, institutional shareholders own 16% of the outstanding shares. The biggest shareholders include Vanguard, BlackRock, and Citigroup. Typically, it's always good to see some institutional participation when holding a stock long term, but it offers a layer of stability and a token of reliability in the medium to long term. It means that the market is confident that it will deliver value in the long term, which is an important factor to consider for the investors. I personally believe that a minimum threshold should be around 25 to 30% for institutional ownership, although there are many exceptions to this rule, as there will always be great companies mostly owned by the retail traders. The current short interest is about 16% of the total float and 52% of the transactions from the dark pools. Typically, if the short interest is above 15% of the total volume, with a lot of it coming from the dark pools, we can argue for the presence of a short attack and the potentials for short squeeze. Right now, for Canoo is at 16%, so barely above the 15% threshold. I would say that there are plenty of reasons why Canoo may be shorted, and it may not be because we just want it to fail. Maybe this is something that is a writing on the wall already. So for this time, I don't believe that there is much of an argument regarding whether Canoo has a short squeeze that has been prepared in the kitchen. I think that nothing will come out of it, and if it has 16% of the short, it's probably because enough people collectively believe that it doesn't really have that. So right now, the global markets are facing a complex interplay of factors that have the potential to significantly influence the equities worldwide. In this speculative analysis, I believe that the consequences of the global inflation, surging commodity prices, and decline quantitative easing, as well as the rise of inflation rates or interest rates, plus the geopolitical instabilities, are going to play a significant part. The increasing inflation rate has been putting pressures across the globe, threatening the purchasing power, raising the input costs, and impacting corporate profitability. Companies operating internationally may face challenges in managing rising production costs and also to sustain profit margins. Those dynamics could trigger market volatility as investors adjust their risk-return expectations. The upward trajectory of commodity prices, including energy, metals, agricultural products, have been having far-reaching implications for various sectors of the global equities market. The companies heavily dependent on these commodities may experience squeezed profit margins, potentially affecting stock valuations and investor sentiment. The reduction or the end of QE's quantitative easing measures by the central banks worldwide may have resulted in reduced market liquidity. So this in turn could lead to higher borrowing costs for companies seeking capital, which may also discourage investment activities or will. The elevated market volatility plus the reduced investors' appetite may also continue to occur. Now, the central banks around the world are tackling this delicate situation of balancing the inflation rates with the economic stability and, if possible, growth. Central banks opted for aggressive interest rate hikes to combat inflations. Borrowing costs for companies have been rising, which has also slowed down business activities and also fueling the market's volatility in terms of the equity prices. Now, ongoing geopolitical tensions, including trade disputes political uncertainties, and social unrests will inject an additional element of volatility into the global markets. Investors may adopt a cautious approach, shifting towards safer assets, impacting the equities. Additionally, the escalating conflicts may disrupt supply chains, negatively impacting the performance of international companies. Given the interconnectedness of global markets, the aforementioned factors have reverberating effects on the US equities market. Companies with significant exposure to international market may face a lot of headwinds resulting from the economic slowdowns, disrupting the supply chains and the currency fluctuations. But nevertheless, the US market is known for its resilience, and the diverse sectors may attract investors seeking safe havens. So, really, the current landscape is characterized by global inflation, surging commodity prices, reduced quantitative easing, rising central bank inflation rates, geopolitical instabilities, and also ongoing lack of certainty regarding growth. While the US market may exhibit relative strength due to the safe haven status, it's going to remain interconnected with the global economic landscape. For long-term investors, these conditions may offer opportunities to identify undervalued companies with strong fundamentals and international diversification. With that being said, short-term trades should be approached with caution because of the increased volatility and uncertainty. And also, we should be careful when assessing individual companies, sectors, or regions. So overall, my impression on Canoo is that it is a speculative stock with a significant downside, but it may also have potential relevance for those who are seeking titles with very high potentials for volatilities in short time frames in order to trade them. For high-risk, high-reward portfolios, it might be a good idea to buy some Canoo shares now. Otherwise, I do believe that there are better investment options elsewhere in the market. I would recommend to commit between 0.5 to 1% of your portfolio in Canoo overall, and to split the allocation in batches of 10 to 20% at a time over the next 6 months.